Hi, everyone. My name is Jeff Praissman with Interactive Brokers, and it's my pleasure to welcome back to the IBKR podcast studio, Nasdaq's Michael Normyle. Hi, Michael. How are you?
Doing well, thanks. How's it going?
It's going great. Happy 2025.
Yeah, you too.
It's great to have you back for a monthly podcast. And, today we're actually going to talk about large caps versus small caps, and we'll get into that in a second. But, 2024 was a wild year, right? With the election and, to kind of put it politely, the uniqueness of how it unfolded with a returning former president running and the last minute switch on the Democratic side. The market still managed to return over 23%. It was slightly weaker than 2023, but it was still pretty strong. And with all that being said, though, the gains weren't exactly spread equally among all, 500 stocks in the S&P. So my question to you is, which ones outperformed the overall S&P and then which ones kind of underperformed?
So like you said, we saw a 23% gain for the S&P 500, which is a large cap index. Another large cap index, the Nasdaq 100, saw a slightly larger 25% gain last year. Both of those indices owe a chunk of their returns to the Mag 7 stocks. So Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla. And so those seven stocks as a group, they gained 49% last year. So about double what the overall index saw. And when you remove the Mag 7 from the S&P 500 and the Nasdaq 100, they both gained about 13 to 14%. So still a solid year, even without that boost from the Mag 7.
And, everyone loves to talk about Mag 7 and also the S&P 500 in general. But I'm curious too, for those that don't know, there's other S&P indices out there. So how did the S&P 400 mid cap do and the S&P 600 small cap? How did they perform over 2024?
So those mid caps and small caps fared a bit worse. The S&P 400 mid caps gained 12% compared to that 23% for the S&P 500 large caps. And then the small caps gained 7%.
A lot of our listeners are in the US, but we also, cater to a worldwide audience. So how about the rest of the world? Overall, like how did Europe and Asia do in 2024?
Yeah, they also underperformed the US large caps. The stock 600 European index gained 6%. So pretty similar to what the US small cap saw. And the same for broad Asia Pacific index as well.
And circling back to the US markets, just from what you just said between the Mag 7 and the rest of the S&P 500 and then the 400 and the 600, yeah, there's really quite a difference, right, in performance. Why did the large and mega cap outperform the small and mid caps in general? And what sort of contributed to that?
Yeah, a lot of it comes down to fundamentals, by which I mean actual earnings growth. So out of that 49% gain for the Mag 7, 33 percentage points came from earnings growth. The rest came from PE multiple expansion, meaning investors were willing to pay more per dollar for future earnings. For the S&P 500, about half of their 23% gain came from earnings growth. And for the Nasdaq 100, it was about two-thirds, with the rest coming from multiple expansion. For the small caps and mid caps, they saw weaker returns because they saw weaker earnings growth. So for mid caps, they saw only about 6% earnings growth, while small caps actually saw 0% earnings growth in 2024. And a big reason for this gap is rate exposure. Small caps have a much larger share of floating rate debt than large caps do. About 40% of small cap debt is floating rate, compared to just 6% for large caps. So large caps were able to lock in low fixed rate debt early on in the pandemic, which insulated them from the Fed's rate hike cycle for the most part. Small caps, though, they saw their interest expense as a share of earnings more than double to nearly 50% in the last couple of years. And that's basically the highest it's been this century, outside the 2001 recession and the COVID recession. And so this higher interest expense was a squeeze on small cap margins, which fell to 6% from 7.5% a couple of years ago when the Fed started hiking rates. And that's made it harder to grow earnings.
So, it's interesting too that, I guess it does make sense that this, smaller cap companies would be more exposed to rates. And then obviously in this environment, they're going to, kind of feel their margins are going to feel the pain more than the large caps. But I'd like to kind of shift over to expectations for 2025, and especially since we're on the subject of margins, what are the expectations for overall margin growth or decrease? And what are some of the sectors that are expected to have the biggest changes?
Yeah, so markets are quite optimistic about large cap margins this year. According to FactSet, the S&P 500 net margins are expected to rise to 13% this year from 12% last year. And that would actually exceed the 30-year high of 12.6% hit in 2021. This relies partly on continued margin expansion from the Mag 7. As a group, their margins have increased from 17% to 24% in the last couple of years. But also, if you look at analyst estimates, they're actually looking for margins to expand across 10 of the 11 industry sectors in the S&P 500. The only one where margins are expected to fall is in real estate. And so the reason for this optimism comes from companies focusing on cost savings in recent years. Plus, you've got lower inflation. So that should help sales growth uh, grow faster than input costs. There's also hope that the sectors that have struggled, like materials and industrials, will rebound after a couple tough years. And the last piece is that potential policy changes under the new presidential administration will be pro growth, which would support margin expansion.
So even so-called old economy sectors like materials and industrials are expected to have sizable increases?
Yeah, so after tech, they're actually among the sectors that are expected to see the biggest gain. And there is some reason to believe that. First, since they're related to manufacturing, they're highly rate sensitive. Of course, we've seen the Fed reducing rates in the last few months here, and there's expectation that we'll see rates fall a little bit further this year. Also, if you look at the manufacturing PMIs, they've been recovering lately, indicating that manufacturing as a sector is starting to turn around. And like we mentioned earlier, they could benefit from those cost savings pursued in the last couple of years. And if we see tariffs, that could boost demand for domestic goods. So the challenge, though, is even though short-term rates have fallen with the Fed lowering rates, long-term rates have actually been rising. So not all borrowing costs have been falling. So rates will remain a bit of an issue for those two sectors.
So given the current economy, this is potentially, and I emphasize potentially realistic expectation.
Yeah, I think so. I think we're coming into 2025 from a position of strength. We've got inflation close to the Fed's 2% target. So that's why we've seen them start cutting rates since September. The labor market has softened, but held up enough that people are starting to see real wage gains. And they've had the confidence to keep spending too. We've described the US as having a Goldilocks economy, not too hot, not too cold. And that's a strong starting point for 2025. So when you add potential further rate cuts, along with potential tax cuts and continued government spending, I think it's a recipe for another strong year of growth here.
With the now increasingly uncertainty on race cuts for 2025, could there be a delay or a market correction in our future?
Yeah, a few months ago, markets were looking for about 6 rate cuts this year. Since then, with the economy holding up better than expected and inflation staying above that 2% target that the Fed has, plus potential for those pro growth policy changes that I mentioned, markets have pulled back on rate cuts. They're now looking for more like 1 to 2 cuts this year. So there's a good chance we won't get another rate cut until mid year from the Fed. And markets have priced that in already. So it's a reason why we've seen markets struggling to hit new highs in the last few weeks. They're starting to face headwinds from higher rates, which can make it tougher to justify relatively lofty valuations that we've been seeing for large caps.
Michael, as always, this has been great. Are there any final thoughts you'd like to leave our listeners with?
I'd just say that a year is a long time. So at the moment, markets are only looking for 1 to 2 rate cuts. But if we see some softer inflation data or some policy changes that had been priced in end up not happening, it's quite likely that we could see an extra rate cut or two this year. And that should be helpful for stocks and the broader economy.
Well, it'll be interesting too, like as this year progresses, to revisit this subject, say maybe like midway through July or August, obviously with 6 months of data, having a lot more to see where everything's going based on January expectations versus 6 months later and exactly how everything's unfolding. As always, we love you coming by the studio and all the great material that you and Nasdaq provide us with. And for our listeners, they can go on our website, click on education, go to contributors, click on Nasdaq, or even go to podcasts, listen to any of our monthly podcasts we do with Michael Normyle from Nasdaq. Michael, thanks again. Really appreciate you coming by the studio.
Yeah, thanks for having me.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.